Good afternoon. I'm Sean Hennigan, the Chief Investment Officer for Aurora Capital. Welcome to the June quarterly update. Well, it was another very positive quarter for our funds, with the growth fund achieving a return of 3.7% after fees and the conservative fund 1.6%. This was certainly not expected after the April 2 Liberation Day announcements in which Trump applied a whole lot of very large tariffs to any country in the world that operated a trade deficit with the US. We won't go into the maths behind the methodology, except to say it was pretty unusual for an island, the Herder McDonald Islands, to be whacked with a 12% tariff when the only inhabitants of that island were penguins. So the US market fell 14% in the days after the announcement, but is now nearly 10% higher. And most markets followed a very similar pattern. The reason for the recovery is based on a couple of things. Firstly, TACO. Trump always chickens out. The administration wound back most of the tariffs, instead giving countries until the 1st of July to negotiate one-on-one treaties with the US. This effectively kicked the can down the road. So far, only 2 countries have negotiated an agreement, Vietnam and UK, and to some extent China. And as of yesterday, 14 countries received letters telling them what their tariffs would be unless they negotiated an agreement by the 1st of August. As I said, TACO. In addition, the hard data continued to be very supportive, whether it's by consumer spending, company earnings, or even inflation. However, this hard data is softening and it continues to support our thesis that global growth will slow. Combining this with global equity valuations being expensive, I think global equity valuations have only been more expensive 10% of the time going back over the last 20 years. This continues to support our thesis of being defensive. What was particularly satisfying actually in the last quarter was we generated very strong performance while being underweight global equities. We achieved this strong performance through our global equity managers materially outperforming the index thanks to very strong performance from our global growth manager, Monroe. And so while there's potential for the big, beautiful bill to give markets a short-term rush, long-term we believe it's going to be negative for global markets. And combined with the ongoing tariff uncertainty and very expensive market valuations, we prefer to remain defensive. Our approach is to take risk when we have been rewarded for doing so. We do not believe we are currently the case. So thank you for your time. If you do have any questions, please reach out to your advisor, and I'm sure that if they can't answer, they'll come to us to get some response. Thank you very much for your time.